Hello, everyone. Thank you for joining us today on our webinar on Streamlined Sales Tax, how you can get free tax services in 24 states. It is right 3 o'clock Eastern here. We do have a couple more people coming in right now, so if everybody doesn't mind, I think I'll just put us on mute here just for a minute and give these folks just 1 or 2 minutes to come back on board with us here, and then we will get started. So hang tight for just a minute, and then we'll get going. Okay, I think we are all set. So again, hello everyone. Thank you again for joining us today. Couple quick housekeeping things I'd like to mention just real briefly here before we get started. All attendees are in listen only mode. We certainly encourage any questions that you might have, but we would ask if you would submit those questions through the GoToWebinar question box. You do not have to wait till the end. Anytime that you've got a question, throughout the presentation today, just go ahead and type those into the question box, and we will be back around at the end of the session to answer those. We are also recording today's presentation. You will receive an email tomorrow with a link to this recording. We have Matt Patrick with us today. Matt's a partner sales manager at Avalara, and he's going to be taking us through the presentation today. I'll be back around at the end to facilitate any questions that you might have. So I think that's it for housekeeping. At this point, I will turn things over to Matt to get us started. So it's all yours, Matt.
Wonderful. Thank you, Rocky. And thanks again for the opportunity to talk about a subject that's really emerging for many businesses today. And it's something that we may have heard in the lexicon of sales tax over the years, but never really drove into it in detail. So what my hope is today is to kind of go through specifically, because as you can imagine, there's a lot of different perspectives of attendees that come into meetings like this, is to kind of go at the topic in steps. Meaning it's helpful to kind of level set, get an overview of what exactly is the SST program and why should I care? What do I mean by free? How do the benefits work? What triggers those benefits of leveraging the SST program? What knocks you out of being able to use the benefits? And then, of course, how does Avalara fit into the whole picture around tax compliance? So generally, I find that this content that we're about to cover today, it runs about 30, 35 minutes, which gives us a good opportunity to do some Q&A. And, oftentimes, obviously, there's some questions related to just qualifications of SST. So let's go ahead and jump into the topic. What exactly is SST? What does it stand for? Where did it come from? Why should I care, right? So the Streamlined Sales Tax Initiative or Governing Board is, in essence, 24 states that have come together to basically unify some tax decisions and standardize a way to file tax returns in their given state. And as we go through, we'll kind of go through why would they do it? Why did they come together to do this? And how does it exactly work? So it's kind of, it's a little fuzzy right now. It's got a name. Only some states are participating. But what exactly are they doing? So in 1999 is really when this process was coming about. And to me, it's a little funny about 1999. I mean, we think about the era, right? What were things going on at the time? I think, President Clinton was probably getting exonerated from his impeachment hearings. Bluetooth was just initiated. Napster was coming out, MySpace was coming out, and everyone was, very concerned about the old Y2K. So I'm sure I'm not the only one that was at a New Year's party that had the power go out that year, as a joke. But back at that time, what was going on from a regulatory perspective is Wall Street and many others were talking about all of these internet companies and just what the economy was going to look like in the years ahead. And states were already dealing with the loss of tax revenue from remote sellers, and we're concerned around, how do we expand our tax base without having the real tools to compel a company to do so. So I'm going to pause for a moment because it's not covered in detail here, but what I'm referring to in terms of the tools a state uses to force a company to collect and register and remit taxes in a state all comes down to the concept of Nexus for sales tax purposes, right? And traditionally, and certainly in 1999, Nexus really followed the physical presence test that came out of the Quill hearing in 1992. And basically, if you had a physical, location there, if you had employees in a state, if you have inventory in a state, and several other common factors, trade shows, states were coming up with a variety of different ways to try to trigger physical presence for a company because they were looking to, of course, expand their tax base. And what these states were looking at and what the problem was specifically at the time was it was so bad that states weren't calling a widget the same. And what do I mean by that is, you think of like in our world, web-based software, okay? It's taxed differently in various states. These states wouldn't even agree on what is considered web-based software, so you couldn't really align it to a category of revenue that would have a consistent tax treatment across multiple states. So it was very convoluted in how the regulatory picture was starting to come together across multiple categories. And then, some of these states just had a burdensome process around filing tax returns. And they said, look, maybe if we come together, simplify how we describe tax categories and how we, try to simplify the ability to file a tax return. Maybe we can encourage companies, especially remote sellers, to participate in a program where we would, in essence, get more tax collected from remote sellers. And we would get, obviously, an expanded tax basis out of this. And by working together, as you look at this map, what is some of the commonalities is that middle section of the US, so many large companies didn't have physical presence there. And the catch here at the time was, look, if you had physical presence in 5 of these states and you wanted to participate in benefits of SST, you had to enter all 24 states, right? And that was a pretty big roadblock for many customers at the time because for obvious reasons, no one wants to register in several more states than what they physically need to do. So the program had some success, but it wasn't taking off to a substantial degree because of that requirement to really have to register in so many states. And again, the benefits were, and what the enticement was for getting companies to consider it is the state said, hey, we'll pay for software, we'll pay for the processing of tax returns, just collect taxes in our state. We know you're not physically here, but you're making sales here. Come on. But again, states or companies didn't want to do that because they just didn't want to have to enter more states than they really needed to. Now, as we look at this map, and this is kind of, again, off topic here to specifically SST and the member states, but recently the state of Pennsylvania, who's not kind of lit up on this map, has, in essence, stolen the SST language verbatim, said we're not joining and participating in the SST membership type side of all of the full members of this program. We're going to self-administer our own program, and we're going to turn it on pretty much right away. So Pennsylvania is kind of a quasi-SST state and really operates mechanically very similar to these other customers today, or states, I should say today. It's a copycat world. So states like Virginia is looking into what Pennsylvania is doing. Other non-SST states are monitoring how that program is going to work for Pennsylvania, because in light of the Wayfair decision, every state is looking at the best ways to balance, expanding their tax base and just managing the challenges that remote sellers, especially small sellers, have with expanding their need to, from an operational burden perspective, apply tax decisions across all these states. So, why was there a need, especially for small businesses, as you think of remote sellers? These were some of the core things that were on the SST's mind at the time. To me, it's mostly the last one, as I probably indicated several times in the last slide, is really, the states certainly know that the changes in rules, meaning the rates, the boundaries, how we tax various products, and just the nature of how to file tax returns across the multi-state environment, and then keep up with it, not to mention the customer exemptions that you have to collect and maintain. It's a challenge. And then the local merchants that are in your local jurisdictions that they're representing feel like they're starting to play at a disadvantage. And so all these things came together to really kind of create that SST environment. Now, recently, as recent as June of last year, and many states were monitoring this case, as they always do. There was a case between South Dakota and Wayfair. For anyone not familiar with Wayfair, it's an online marketplace that's, well, not really marketplace, but website that sells oftentimes like home goods. It's pretty neat. You can take a picture of a room, and it will, basically you can put products that are on their website into your room. And it's quite popular, but as you can imagine, they're not necessarily physically located in states like South Dakota. Well, South Dakota is pretty sensitive to this because just their budget in terms of revenue that comes from sales tax is critically important. And their feeling is that remote sellers are kind of getting a free ride. And companies like Wayfair might be a good example. So they brought them to court, went all the way to the Supreme Court. The Supreme Court weighed in favor of South Dakota. And what South Dakota was arguing is, physical presence was good when it came out, but frankly, 1992 is a lot different than 2019. And we feel economic nexus is a better measurement of, should a company be compelled to register, collect, and remit taxes in our state. And what came out of that ruling was economic nexus thresholds, right? So the thresholds that predominantly that you see that came out of this case is the 100 or 200 separate transactions or dollars overall. So this came out in June. Literally 3 states just non-practically made it effective as well in July of last year. And I think today we're at about 30 states that have enacted it. Ohio just passed some economic nexus legislation, I think just recently. It's an easy decision for many states to do to expand their tax base once this went through, right? Now, around the thresholds, there are states that have some differences in how they treat qualifying transactions, right? So some states, and the way Supreme Court ruled in this case with South Dakota, was that total sales, so your retail and your dealer or wholesale sales, count towards qualifying transactions against the threshold. And as you can imagine, especially for many industries, I mean, you could have 90% of your sales are exempt at how many transactions, right? Representing how much in dollars going into a state. You practically paid very little in taxes, but they're asking you to register. I mean, these are some of the dynamics that, of course, from a regulatory perspective is probably not thought about, but that's what we're managing today for, or what customers are having to manage through as a business. So a couple examples of what I'm describing, right, is you'll see that threshold here in Alabama, it's 250. You might see that combination of and or is a pretty big statement in terms of how they're qualifying transactions for each particular state. So Avalara has a component on our website. More than happy to make sure it's either added to this presentation or sent after the call, but it allows you to really point and click on which states you want to review, or all states, and then it has all of the detailed regulations related to economic nexus, the thresholds, what are qualifying transactions, what's the look back period, etc. So the next thing that starts to come up is you have several businesses that we'll say sold online, or just frankly sold, they took orders on the phone from neighboring states, or, obviously if you're in Ohio, it's not uncommon to have California customers. They're just that big. It's a huge economy. And there's a convergence, right, between economic nexus and what is a streamlined sales tax state. And it starts to make sense to really evaluate, well, gosh, I don't have physical presence there. I'm getting forced to register from economic nexus. Streamlined sales tax is a potential opportunity if I can get them to fund applications that help support the complexity of it. Like if you enter California, for anyone that probably is there, knows what you're dealing with, but if you're building all that stuff manually, it's probably somewhere in the neighborhood of like 1,300 different taxing jurisdictions that you're dealing with, from state, county, special jurisdictional taxes. You're dealing with potentially taxability rules on different products or services. You're dealing with exemption differences. You're dealing with the fact that California wants to generally tax things that you sell to a school versus everywhere else you deal with. It's exempt. It's one thing after another, quite honestly. So companies are saying, well, I still don't necessarily want to, if I have economic nexus in 5, I don't really want to enter 24 states if I don't have to. Earlier this year, the Streamlined Sales Tax made a change to their policy, which is quite substantial, meaning you can now register specifically in the states that you have a need to, but you're not necessarily forced to register in all 24 states. And the impact of that certainly makes the proposition of the evaluation of this type of program and the convergence of your economic nexus and what streamlined sales tax states are available, how that comes together to see what benefits might work best for you. So I mentioned benefits probably more than 5 times, and it's good to kind of cover explicitly what I mean by that. So within the SST program, there's what they call volunteer registrants or sellers and non-voluntary. So a voluntary registrant will have basically no physical presence in a particular state, and some of the free services available are, instead of doing the paperwork, a certified software provider can do the paperwork to get you registered. Instead of licensing software for the transactions, meaning where the content, so the boundaries, the taxability rules, the rates, think about rates. There's like 15,000 different rate combinations across the country. 7,000 of those are covered in 24 states. Fantastic. So content is covered. Filing, what they're saying, by simplifying and encouraging customers to use the program, they also encourage the simplification and the operational burden for you to not have to do all of the filing. You're really participating in having the service provider file those returns free on your behalf. Audit assistance and response. So as a customer goes through an audit in an SST state, as a certified software provider, they are audited by the SST program around things like the content that we're supporting. Because remember, all of these states came together to agree upon common rules, common language, not necessarily that they need to charge X rate, not necessarily that they need to agree that one thing's taxable or not taxable between states, but again, at least uniformly calling things the same thing, ridiculously enough. So obviously there's, let's see, this is the next component of what's very important to know that would basically preclude you from participating in the benefits and would generally make you a non-voluntary status registrant, or if you're existingly registered in these states that you're and you're physically there, that would preclude you from participating in that state's benefits, but you can still expand the view of what other SST states and economic nexus or other nexus requirements, how does that converge for evaluating any benefits between those two programs. So, looking at what this is describing is, and why I say it really impacts remote sellers that don't have physical presence there, is these are the four main requirements that you'll find would push you into the non-voluntary status, and it goes right to fixed place of business, right? Value of property. If you got inventory, you got a building. Do you have people there, right? Do you have the combination of a percentage of total property and payroll? So these components come together to basically say, are you on the left side or the right side? Are you volunteer, non-volunteer? And then that analysis can kind of help you understand, some of the options you may want to consider. So automation makes sense. Certainly, if you're going from an environment where economic nexus or other needs of expansion, acquisition, expanding sales forces, your traditional means of even having to expand nexus, regardless of SST, if you start getting into that 5, 10, 15 states, and what a lot of the customers that we're talking to in the past year with economic nexus, they're going, I like to call it 0 to 60, because they're going from 2 or 3 states to, oh my gosh, now I got to deal with economic nexus. I actually need to register in 20 states. I need to collect thousands of exemption forms that I no longer or didn't used to have to do. And I need to file tax returns. Like, their life around complexity of sales and use tax compliance just really exploded overnight or in a 6 to 8 month period. And, certainly as a certified provider of SST, we can help customers kind of evaluate the program and analyze where they're at from both economic nexus, physical presence, and just fit that together to what the SST states are to kind of give you a good evaluation of it. Now, AvaTax is certainly a web-based application that integrates with, 700 now certified connectors. And what I mean by certified connectors is generally we work with publishers around connecting our system for determination to their various billing processes, whether it's e-commerce, ERP, POS, mobile, you name it. And we need uniformity, right? Because it's more common today than even a decade ago that we'll walk into an instance where, I just had one yesterday, there will be 5 different touch points between different technologies that will require a tax decision or an aggregation of data to get to a tax return for that particular customer. So, obviously common examples would be your financials, websites, multiple websites, different business units on different integrations, or I should say ERPs, ranging from, your obviously your Microsoft stack of solutions in the GP space. And then even in the GP space, you think you got things like SalesPad, you got, obviously AZOX, binary stream, if you're multi-entity management. I mean, it can really get into a lot of nuances with where tax needs to occur. So the integration is where it really starts from an automation perspective. And from a compliance or regulatory standpoint, why Avalara came to be was, you think back in 2004, so we're 5 years after 99, right? And, Salesforce was obviously starting to really help the business community understand some of the benefits, frankly, of a web-based application. And, founders of Avalara kind of looked at this problem and said, how do we bring the cost down and make it affordable for especially small to the mid-market to afford a tax solution? Because everything really at the time was pretty manual. It was either building rates yourself, it was loading a rate table that was kind of challenging to keep up to date. It was building your own tax schedule rules within that environment. And then you had the whole back end of that with reporting, depending on how you structured it on the front end, caused it to be easier or more difficult to file a tax return. And then you had exemptions and all that to build and maintain within your processes for compliance. So the general thought was, does it really make sense to have all of those moving parts local to the billing environment? And the answer is no. I mean, frankly, it just made no sense at all, because it's a constant scenario or situation where you're constantly having to deal with what's changing. So Avalara came together and they said, you know what, how do we improve the whole process? We put all of the boundaries and the rates all on the web, and we'll just create integrations to, to that service to get access to the content. And when I say boundaries, one of the things that we do is we look at an address and convert it to lat longitude dynamically, because in our content, our boundaries are all lat longitude based. And in certain areas of the country, you'll see issues with ZIP+4 where the rate will be, there's common examples in Colorado where you could be on the left side of the street and it's 8% practically, and the other side of the street is 4.75%, with 6 different layers of tax. That's kind of how the structure came together, and then of course they added on compliance and exemption management from that perspective. I started here 7 years ago. There was probably about, 200-ish employees, maybe 4,000 to 5,000 customers. And, today we're up to about 1,700 employees, 25,000 customers. And we went public last year. So, it's a combination of the right tool meeting a broad set of problems across a broad set of market that's kind of helped driven a lot of Avalara's growth. And, we're very interested in helping anyone that may have questions around, does tax automation even make sense for what we do? This is what options might we want to look at to see, is automation worth doing, and what might be the best approach regarding the various different paths you can take to automate. So with that, I will open up the lines and see if there's any questions, comments, or follow-up from today's discussion.
All right, great. Thanks, Matt. I do have a couple questions here that came in while you were going through there. The first one is, can you describe volunteer versus non-volunteer states?
Yes. So think of it as this. Well, let me break it into 2 parts. So you have SST states that are part of the program, and then you have non-SST states that are just everybody else. So let's just focus on that first. Your 24 SST states, when we're describing volunteer versus non-volunteer, that's really every one of those 27 states has, as part of that governing board, as I scroll back to it, this requirement to see if you would be a volunteer registrant or a non-volunteer registrant. And what that means is if you basically have physical presence in our state by having a fixed place of business, inventory that is company owned, you have payroll folks on W-2 employees in the state, those combinations are starting to put you in the non-voluntary status. And that's why it's really, looking at, generally, if you already have these requirements on the left here, you're likely already registered in the state, quite honestly. But there are some companies that have registered in states that they pulled out of, meaning the person that was hired there remotely no longer is with the company, or they were there for whatever large project 5 years ago and they just never pulled out. So, there can be instances where we can reevaluate that position around voluntary and non-voluntary status, even for those currently registered in a state. Does that help answer the question?
I hope it did. We have one more here from the same person, kind of similar, along the similar lines there. And let me just remind everybody, if you do have any questions, please just go ahead right now and type those into the question box there on your GoToWebinar icon there. So we've got another one here, Matt. What is a full member state?
Good question. So a full member state really goes through, it's probably more than we can cover in today's call, but in essence, 23 states do everything precisely the same, and Tennessee is the one non-full member state, and they have pulled away from doing a couple things. It doesn't necessarily mean that anything that we've discussed today as far as the benefits that are available, are not available with a non-full member state. It's really a bit more nuanced than that. And when you think of states like Pennsylvania that says we want to administer what you guys did, but we don't want to join at all, to be not even associated with the governing board, but we're going to execute this program. There's a possibility if we were to do the same call a year from now, more states that are not part of SSTs, or your traditional non-SST states, looking at what Pennsylvania is doing and potentially enacting similar language and a program on that side as well, which I'd get quite interesting.
Okay, we've got one more here. The question here is, I think you covered this at the beginning, but why was SST created in the first place?
Yes. So SST, just keep in mind, it was back in 1999. So this is the height of what, like pets.com and all the internet, the internet companies that didn't quite make it because it was just too early. Everyone was still dialing through on American Online and internet was slow. And so, but the projections at the time were, and it was quite honestly difficult to fathom the projections that they were talking about in 2000 in terms of how much of the economy was going to move from local retail to online sales. But it was substantial and governments weren't ignoring it. So that was part of it, is really just that lost revenue that was potentially on the horizon from remote sellers not having a physical presence in a state. And the current laws at the time were just that. The only way to get a Wayfair to register in South Dakota was for Wayfair to have employees in South Dakota, a physical building, right? Maybe they traveled there several times for trade shows, or could be a variety of things that generally were physical presence related. If they didn't do that, Wayfair could have, I don't know, 50 million in sales hypothetically to South Dakota, and South Dakota would have no legal ability to force Wayfair to collect taxes on their behalf. But yet the fact that Wayfair is selling into their state is hurting some of the local businesses, or there's a feeling of non-competitiveness. And from that perspective, they wanted to also look at how do we simplify things? Because again, today it's a lot easier to classify what you sell into categories that states across the country agree to. And it was more difficult back then to create automated decisions if states couldn't even agree on the fact that we don't classify this type of product, good, or service as the same thing as another state. So coming together on at least uniformity of how to classify your products and services was certainly a substantial component of this, to simplify it and make it more attractive to, if we're going to ask companies to consider registering in our state without physical presence to participate in benefits, then we need to make it simple to do and execute for those that would be participating as a certified software provider.
All right, perfect. Thank you. That's it right now, Matt. That's all the questions that we had. Do you want to close with anything?
I would. Yeah, Rocky, again, wanted to thank you for the opportunity to talk about an emerging topic that I think will, like I said, even change as we look at this next year. And if anyone does have questions around just specifically what your circumstances look like, is physical presence, economic nexus, does SST even apply? Does automation apply? Just feel free to email myself or my colleague Stacy directly. Reach out to Rocky and the Velocio team. More than happy to kind of do a free analysis to look at things, provide it to you, review it, see if it makes sense, and take any action if it were to make sense at that point. So I want to thank you all again and enjoy the rest of the afternoon.
Okay, great. Thank you, Matt. I appreciate it. Very, very informative session here this afternoon. Certainly appreciate it. And want to thank you guys, the folks there at Avalara, for for coming on and sharing that information today. So yeah, as Matt said, if any of you have any additional questions, want to take a closer look, get some things answered, please feel free to reach out to your CSM, and they will be happy to engage with Matt, Stacy, or any of the other folks at Avalara and get any questions that you might have answered. So thanks again for joining us. We certainly appreciate it. We look forward to seeing you on some of our future webinars. And with that, we'll close things out. And from all of us here, we'd like to wish you all a great rest of your day. So thanks again for joining us.